Welcome back to Financial Fortitude, the podcast that helps high earners, families, and business owners live well today and plan wisely for tomorrow. I'm your host, Michael Acosta, joined by my co-host, Brady Hemmerly.
Today, we're tackling a topic that no one wants to face, but everyone should be prepared for: losing your job. Whether you've been laid off, downsized, or you're just seeing the writing on the wall, the financial and emotional impact can be huge.
That's right. Losing a job can feel like the rug's been pulled out from under you, but this doesn't have to derail your long-term goals. In fact, it can be a turning point if you know how to stabilize your finances and plan strategically during the transition.
We're going to walk through exactly what to do in the first 30 days after a job loss, from managing your cash flow to navigating health insurance, and even finding opportunity in what might feel like a setback.
Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We're your hosts, Michael Acosta
and Brady Hemmerly. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in.
Brady, this topic in itself is something that I will say is eye-opening and also somewhat encouraging in the sense that by being overly prepared, when life throws a curveball at you, it helps soften the blow, in my personal opinion. And we're going through a period of time where government employees are being furloughed or at least not being compensated right now while the government is shut down. There are some companies that have had mass layoffs nationally. And so people are being impacted. And I think it would be prudent for them to at least have some sort of game plan in place so that if this is something that comes completely out of left field, they're not completely caught off guard.
Yeah, I think the conversation is timely. With any disruption in the overall industry, and what I mean by disruption is when we hear the words AI, I think that's what everyone's hearing or talking through these days is, hey, big disruption in the industry. Is my job either being impacted now or might it be impacted in the future? And I'm either seeing the writing on the wall or I have absolutely no idea that I may get laid off or my job may end. But what do I do if that happens? Because it's a concern that more and more clients that we work with are seeing and kind of talking through day to day. It's becoming more of a risk front of mind for everybody.
Yeah. And so one of the things that I like to refer back to is when I first started driving, I don't know if your parents did the same thing, but there was a quote unquote survival kit that was put in the car with you, right? So that if you ever got stranded on the side of the road, you would have what were deemed the essentials to get you by until you were able to get some sort of help or get back on the road and keep moving. Our goal today is really to be able to provide some sort of survival kit, quote unquote, that will help you insulate your financial plan so that if a layoff does happen, if a job loss does happen, that your financial plan isn't just completely blown up or sidelined.
And I think that's an important use of words there, this idea of survival kit, right? Because everyone's situation is going to look uniquely different when it comes to a job loss or layoff. Hey, I may keep my insurance, I may not. I may have a job already lined up, I may not, right? I may have a tough time finding new work, I may not. So I think the pros of our whole conversation is what needs to be in the survival kit for everyone that is more evergreen in nature. And then as we talk through some of those specifics, listeners can pick and choose or at least begin to observe, hey, that does apply to me or maybe not quite.
So
I guess the question that I have, Michael, for you is talk through the basic foundation of that survival kit. Where do clients and listeners need to at least focus their attention first when we're talking through what goes in the kit itself?
So the first thing that I would say needs to be in there would be your financial advisor's phone number or email address, right? The moment you find out that your income has gone away by way of job loss or something to that extent, you should be on the phone with your financial advisor and or their team after having digested what has just happened and speaking with your loved ones. Because it is an emotional event, especially if you've been with a company for an extended period of time and you thought you were going to retire within that company's framework. If you get caught off guard, it could be overbearing emotionally, right? So again, speak with your family, take some time to digest it, but then contact your financial advisor because hopefully they've done some of the legwork to put some of these safeguards in place for this type of event, right? The unforeseens, the risk. Now, beyond that, I would say the basic essentials of a survival kit are really going to be focused on cash flow, emergency funds, and just a game plan in general. Something that has option A, option B, option C, maybe option D, as far as things that will need to be implemented, or, different sets of quote unquote dehydrated meals that we can throw some water on and eat over the course of how long this job loss situation lasts in your world.
So 2 things that I like that you pulled from there is, first and foremost, jokingly, perhaps a little bit, is the financial advisor's phone number, email needs to be in the emergency kit. Joking aside, I think it is important to have someone in your corner who's not as emotionally attached to the outcome of a job loss or layoff.
Correct.
Right? I think generally poor financial decisions get made when emotions are the lead driver of that decision. So I think there's a lot of value in having someone that can look objectively and say, here's what I understand from before the job loss. Here's what happened. Here's what our world looks like and our survival kit looks like post-job loss. Let's attack this with really a third-party, non-objective opinion just to move the ball forward rather than to make an emotional decision. The second thing that I love that you pulled out was cash flow, right? Cash flow while we're working is the lifeblood, the foundation. It kind of builds everything around it. So when cash flow gets interrupted, it should generally be the first place that we stop and determine, hey, where is the bleeding coming from? How long might that bleeding last? What other resources do we have to kind of patch a wound here? So talk to us more about when it comes to attacking cash flow as kind of the foundation of the whole financial picture. What kind of things are we talking through with clients, or what do clients need to be thinking through?
Yeah, and this is going to touch on where you laid out at the beginning how it's going to be different for everyone, but we're going to try to make it as evergreen as possible. And so I'll break it up into 2 distinct categories. Those are dual income households and single income households. At a baseline, from a cash flow perspective, if I'm a single income household, it's going to be pretty tight, right? If I'm dual income, we're just losing maybe 50% depending on the ratio of each earner. So we're losing a percentage of our household income. But the first place we're going to stop as we start to pull everything out of that survival kit is, okay, well, let's review our budget. Let's look at what our expenses look like, and let's identify or revisit which ones would be considered fixed versus variable, or even needs versus wants, or discretionary versus non-discretionary, so that we at least know how much do I need to be able to provide or come up with on a baseline monthly basis, so that I don't lose my house, I don't lose my car, and I don't start to accumulate unnecessary revolving credit card debt, which tend to have higher interest rates. So again, step 1, that stop's going to be, okay, well, let's triage the expenses. Let's see what can be trimmed for this season of life, and let's see what has to stick around just because it's a basic essential need.
So how do you think through that differently from a single income versus dual income perspective?
Well, from a dual income perspective, you're probably going to not cut as aggressively, because it could be a smaller amount that's being lost income-wise. If it's a larger amount, you might cut more aggressively or trim more aggressively as far as those expenses. But you may not have as much of a disruption to your day-to-day spending or lifestyle if it's dual income, because you know inherently that you still have some income coming in. It's just the shortfall of what your total lifestyle need is that's being disrupted.
Yeah,
right?
A great example. If I lose my job and my spouse is still working, odds are her income could still cover the mortgage, the car payments, the tax payments, the everything else that we absolutely must pay for to continue to advance forward. Losing my income will certainly hurt, but it won't feel as tough to have to determine, hey, how are we going to make a mortgage payment versus can we go out to eat as much this month?
Correct. And one of the things that has to be considered from a cash flow standpoint is, okay, well, based off of you being laid off or furloughed or let go, is there any severance? How much is it? And what does that look like? How long can that last until you're able to find your next position if your intention is to re-enter the workforce in some capacity? Now, if we've done really good prep work, if we've built a really strong, deep, and wide moat around our financial fortress, we've likely have set aside an appropriate amount of emergency funds, liquidity, risk-free cash that we can access. And we've talked about this in past episodes. But the CFP board recommends for a single income household to have as much as 6 months worth of living expenses in risk-free cash, liquidity. Whereas if it's a dual income household, 3 months, right? So as an example, if my lifestyle for simple math is $10,000 per month as a household, if it's dual income, we should have about $30,000 in risk-free cash. right? Probably parked somewhere in just our regular checking, savings, maybe a high yield savings or a high yield money market. If it's a single income household, because there's greater risk for the loss of income, we want to have closer to 6 months. Now, this is where it deviates based off of the individual or household's appetite for risk. If you are a greater risk taker, you're probably going to have less cash on hand. You might have other investments that you can divest and liquidate and sell. But again, CFP board recommends that single income household, 6 months of living expenses, dual income, 3 months.
So let's say we've done a good bit of prep work. My spouse and I have done. So, hey, I've got somewhere in the neighborhood of 6 months worth of living expenses built out. If I lose my job, is it time to turn that lever on? Or are there other things that I need to think through first or consider first before I go straight to the emergency fund? Really, is this an emergency?
Yeah, so I would say you would have to look at, okay, well, do we have income coming in from other areas, and am I eligible for income from other areas? Meaning, are there any sort of short-term income options that I can pick up by way of consulting, part-time work, or even just monetizing the skill sets that I have? I've had this conversation with my wife many a times as the primary breadwinner. If I lost my job, I am not too proud to cut people's grass, do lawn work, do some remodeling, or even go work in a fast food restaurant, assuming I can get hired. So just figuring out, one, is it worth your time to go do some sort of job for some amount of income? Or are you eligible for unemployment? And if you are, starting that process, filing it, and understanding what all that entails. And we're not going to go into great detail of what all that entails and what that process looks like, but that is a benefit that's out there that people are paying into. So if you need it, sign up for it, just don't abuse it.
So what I'm hearing is step one in the triage process is begin to identify what a discretionary versus non-discretionary expense looks like in your household. Using that information and also knowing whether we're a single income or dual income household, begin to understand what our monthly burn rate is going to look like with this life change. Once that's done, it's beginning to explore options like, can I or will I go into part-time work, consulting or moonlighting work, or even work in a different industry? What does my unemployment benefit status, what could it look like if I file and get approved? And then what I'm hearing is once all of that's done, it may be time to pull the lever on the emergency fund. Does that sound right?
That's exactly it. And like mathematically, it could be, okay, well, dual income household, our lifestyle is 10 grand, right? Let's just say our basic needs, like the necessities, are 7,000. So there's about 3 grand in fluff, comfortability that we can eliminate or trim. Well, if my spouse's income provides, let's just call it $5,000 per month, well, we can meet all of our basic needs by drawing down $2,000 from our emergency fund each month, right? Assuming that I don't qualify for unemployment. If we want to keep everything status quo, then hopefully if we have the means in our savings account, our emergency fund, we can just pull the delta of $5,000 and now we got 10 grand per month. Now, I've seen this in practice. I've seen it implemented with clients who they did a phenomenal job at building an emergency fund, and they had transitioned from dual income to single income, and the working spouse ended up losing their job, and they took about 3 to 4 months off to take their time at finding the next position that really aligned with their values and the type of culture and work environment that they wanted to work within in the medical field. Had they not had that moat, that emergency fund, as large as it was, they would have felt a lot more pressure, and the working spouse would have just taken the next available job. So for them, it wasn't quote unquote an enjoyable experience being let go unexpectedly, but they made the best of it, right? They made lemonade from the lemons that were provided.
And I think having a survival kit that has been prepared, right? Understanding the process to go through from a cash flow perspective, understanding what the right amount of emergency cash is, it's helpful, as you mentioned, because one, it absolutely closes the wound of, hey, we need money for things that are non-discretionary, and if we don't have money, it's going to be a big problem. But I love the point that you mentioned is having a moat built around your financial fortress buys you time to go out and explore the next best opportunity rather than just the next available opportunity.
Yeah, we don't want quick fixes. We don't want to just put a Band-Aid over the severed artery, right? We want to make sure as professionals and practitioners that we're getting into the next best situation, not just a lateral opportunity that doesn't really solve the need aside from monetary support, right? If we don't have to, because then you're just going to end up jumping to the next job in a couple months if you're able to land a position that you really love. Now, from there, I think it's a matter of reviewing benefits that might have been lost. Too often, workers can get too what I will call invested in group benefits and not focus on insulating themselves from the unknown. And what I mean by that is if all of our life insurance, all of our disability insurance, all of our, more often than not, health insurance is going to be through a group plan, a group benefit. If we lose our job, those benefits go away. Now, from a health insurance perspective, if I'm a single income household and my entire family's on it, such as my situation is, well, that's a huge risk. Now, that is a triggering life event. We've talked about this in our open enrollment episode, but that would give us the opportunity to then go to the marketplace, or we can opt into COBRA, which will be a little bit more expensive than what we were paying premium-wise. So the trade-off there is, okay, well, if I'm the maid breadwinner, I lost my health insurance through my group benefit because I was let go, I can pay what's typically, I believe, about 110% of what the premium typically is. And usually I'm paying a fraction of that because my employer is going to supplement some of that for me. Or I can go to the marketplace and hopefully qualify for some subsidies to bring that cost down a little bit lower, right? Because if I'm feeling pressures of being on a tighter fixed budget, I probably don't want to pay 110% unless it's just the convenience of the mechanism.
Sure. So what I'm hearing from you is single income household or maybe dual income household, but no benefits are offered with spouse's employment. My options are twofold. I can either just pick up my existing coverage with COBRA or go out into the marketplace and pick up essentially private coverage. Now, which one is best, I think depends on your situation and depends on where your income stands otherwise, right? For many clients who have a lot of doctors in network with their prior employer plan, they expect their period of unemployment to be short. They may not qualify for a number of subsidies. Convenience-wise, COBRA could make more sense. For clients who have a lower income or whose income would be notably impacted, who may be eligible for subsidies, maybe do not have a more restrictive network of doctors that they can see, marketplace may make way more sense in that instance. So that's just something worth speaking to a health insurance professional and your financial professional side by side and saying, hey, what option do I go with?
Yeah, because the timing of everything, I think, is going to play a factor in this as well. How long will the main breadwinner be without a job, right? Because there are certain windows that you have to be mindful of. And we're not going to get into those fine details because they change from time to time. And again, just to overemphasize, we're talking about accumulators at this point. We'll highlight what this might look like for someone who's closer to retirement as a pre-retiree. But in this case, primarily accumulators, young families, young individuals. But if it's a dual income household, well, this is a triggering life event. And so you do have the option of reviewing your spouse's benefits to see if it makes sense for you to get added to their health plan. Let's just assume that both me and my wife are working and everybody was on my health plan. I got laid off. Well, now we have the option through a triggering life event to put everybody on her health plan. And so that's where, to your point, mathematically running the numbers to say, okay, is this the best situation? And understanding what all that comes with, because you may have to change your primary care physicians and specialists that you see based on the change in health insurance. But it's also understanding that this isn't your forever, hopefully, right? Because if you're able to get back into the job market and get benefits again, well, then you can reset the table, reassess cash flows, and redesign what your risk management profile should look like from a financial immune system standpoint.
So, Michael, the other question that I have is, what other considerations do we need to think through when it comes to protection, most especially health insurance, before making a quick decision about marketplace, COBRA, spouse's employment, etc.?
Yeah, so from a risk management standpoint, protection standpoint, I would say that if cash flow is tight, the first place that people tend to look at is eliminating their home security system, right? Because it's viewed as a non-essential. Now, what do I mean by that? Well, if I have personal life insurance and personal supplemental long-term disability insurance, or if I have a umbrella policy with my property and casualty provider, those are going to be viewed as non-essentials. They're great when cash flow is strong, but when cash flow is tight, it's like, hey, why do I even have this? Well, the reason why you have those things is because there are daily assaults on you that we don't see that could lead to wealth creation being completely stopped or eliminated. What I mean by that is that regardless if you have a job, you can still be sued. regardless if you have a job, you can die untimely. Regardless if you have a job, you can still become too sick or injured to go back into the workforce, which is known as a disability or long-term care event, right? Depending on which side of the mountain you're on, accumulating or distributing. So you still need to factor in that emergency fund, which is why we include the cost of your protection in your monthly lifestyle. You still need to factor in keeping those in place so that if one of those additional negative events occurs, your financial plan isn't completely blown up, right? And so it's also understanding that if all of your benefits, life insurance, disability insurance, if everything is through your employer and you just got let go, well, now you're completely exposed. And for individuals who claim to be more conservative, that's actually a very aggressive stance to say, hey, I'm going to keep all of my risk management solutions in a group benefit where I have zero autonomy over whether or not I stayed employed or not.
Got it. So I think big picture, what I'm hearing for you is we need to assess from a cash flow perspective, needs versus wants, proper emergency fund, when to pull the lever on emergency fund with other variables. From a protection standpoint, understanding what options do we have, what makes the most sense from a convenience, a timeline, and a cost perspective. And then also understanding that, hey, if our benefits are wrapped up with our employer, that it leaves us exposed in an instance like a job loss or a layoff. So we've covered, I would say, the financial foundation of cash flow. We've covered the roof over top of the house with protection. I think this is oftentimes where clients jump first because it's our first thought is, what do I now do with my severance package? What do I do with my 401k or perhaps 401k loans? How do I change my investment plan based on this job loss that's now happened? Talk to us more about what clients need to begin to consider when it comes to the rest of their financial picture, the assets, the bonuses, the investments, the dollars.
Yeah. So again, like you mentioned, this is usually the first ripcord that individuals are going to focus on or touch. And I would say you have an opportunity here to slow play this until you get everything else foundationally assessed, analyzed, and redeployed, right? Cash flow, like you mentioned, is the living blood of your balance sheet. It's how you make financial decisions. And a lot of times it can be overly emotional. Your protection, right? Your risk management, making sure that you're insulating your balance sheet and your future self from additional unforeseens, additional risks. Well, the assets that you've accumulated that might be tied to that employer, these are going to be things that we can take our time with, meaning that, okay, well, we've slightly mentioned it earlier, but severance, what does that look like for you? If you had any built up PTO, how can that be paid out, if at all? As well as unvested stock options, RSUs, right? Are they completely lost? Or if you're on severance for the next, let's call it 40 weeks, and you end up triggering a vesting period, will those stocks be available to you to then liquidate and replenish your emergency fund, right? Or dedicate towards other areas of your balance sheet in that given moment based on your overall need. The other thing is understanding what are the rules for outstanding 401k loans. And what do you do with your 401k if you're no longer employed there? What are your options? And should you be quick to move them somewhere else? Or if you land another job, does it make sense for you to roll them into the next employer plan? And we have somewhat of a scenario that we can talk through of a client who's gone through something similar with some of these elements.
So Michael, let's talk through at least an example that we've seen more recently. Let's say my spouse and I are a dual income household, high earners. Both of us earn, call it a similar amount of money. I recently got laid off, and my company has awarded what is a 40-week severance, so a number of months. Call it a small PTO payout. I've got a pretty big 401k with them. I'm curious whether I should move it. The challenge is I have a small loan against it for a project that I was working on. I'm getting closer to retirement. I'm not quite there yet. And I've got an emergency fund to consider leveraging, but I'm not really sure. So just talk to me from a case perspective. What things are you thinking through? What actions or options might I have?
Yeah, so I would say we're going to refer back to the emotional blueprint, right? We talk extensively about your lighthouse and the goals and concerns and objectives that you're trying to work towards, those being what drives your financial decision making. So I think at a baseline, again, we've looked at the survival kit. So we already know that we needed to assess cash flow, lifestyle, and any other basic needs there. In this scenario, because the one spouse is still working, we already know that from a medical insurance standpoint that we're going to be transitioning over to the working spouse's benefits once the non-working spouse is terminated completely in the system. Well, as far as the 401k, if there's a 401k loan, well, in this scenario, we had a couple options. We can take some of the stock options that we want to liquidate and, we can put that into our emergency fund for a later date just to be able to survive in advance until the next position is landed. Or we can use that to pay off the 401k loan. Well, now let's just call it $40,000 less in emergency funds, liquidity. My bias is that I would rather have more money in hand to be able to bolster my defense for a little bit longer in the event that I need it versus giving it up in exchange for being able to roll my 401k out. Now, the option that this individual has is that they can continue to make payments towards that 401k loan, I believe, over the course of 60 months. They're getting severance for 40 weeks, so they're still getting some pay, and that pay is probably going to be a little bit higher than what it typically is because they're not going to have all the benefits being withheld from their pay. Now, depending on the sentiment of the individual, they might say, hey, I want nothing to do with this employer anymore. They completely abandoned me. They turned their back on me. I want to move my assets away. I don't trust the way that they're managing the 401k plan, whatever it might be in that emotional sentiment. One option that we look at would be, okay, well, what does the working spouse's 401k plan allow? Do they allow 401k loans? If so, why don't we just repurpose the loan from one 401k to the other? And we can continue to make slow payments towards that loan over the course of 60 months, knowing that, hey, we have the cash reserves to pay it off in full once the non-working spouse re-enters the workforce. The other thing for this specific situation is that there are some, let's just say, unvested RSUs. Well, if I'm still receiving severance, I would want to confirm with my employer that, hey, if my severance is being paid out past a vesting date, do I then get those stocks that vested, and are those mine? Or because they were unvested still at the time of my termination, are they completely lost? And if they are still available, well, guess what? That is another injection of cash that can rebolster, fill back up any of the monies that were used in our emergency fund to survive in advance and cover the spread between what our lifestyle looks like and what the working spouse is providing.
So it sounds like, at least me in this case, if I'm the example here, I have a lot of options to consider, and jumping straight into one quick option, either from an emotional standpoint or just, hey, let's get this done standpoint, I've got extra time, may be detrimental to me without going through the survival kit and the exercise to say, hey, what does my cash flow situation look like? How are my benefits affected? What options do I have? And then let's pause and take some time to actually digest everything before taking quick action on what could be a pretty big financial decision.
Correct. And I would say that there are other things that we would want to consider that we haven't discussed yet, like a securities-backed line of credit, depending on if we have non-retirement, taxable investments, a home equity line of credit. If we have one already established, it might be hard to get one established if we just lost our job because they're going to do some financial underwriting. But we talk more about this in episode 25, how the wealthy use SLOCs to borrow tax-free without selling. So again, just if you want to learn a little bit more about other ways to leverage your balance sheet without giving up control of assets, that would be a great episode to go back and listen to in conjunction with this one.
So that actually leads almost perfectly into the wrap-up of our episode is, despite how shocking and perhaps defeating a job loss, a layoff can feel, it can oftentimes come with a number of opportunities. I think both from an emotional and personal standpoint, and then also from a financial standpoint. So Michael, if we start from a financial standpoint first and then move more so into a personal standpoint second, what are some opportunities, if we're going to make lemonade out of lemons here, that clients need to consider or have in the back of their mind, or should their financial professional be speaking with them about in the midst of either just before or during or just after a job transition?
Yeah, I would say once you get past the emotional roller coaster of this unexpected event, just kind of blindsiding you, I would say there are opportunities potentially at hand to maximize not only your taxes in that given year, but also your long-term financial plan, right? Especially as an accumulator or a pre-retiree. Now, what do I mean by that? Depending on when the job loss occurs and what the projected end-of-year total household income is going to look like, this could be the perfect opportunity for you to start to look at conducting Roth conversions. Why? Because if you only worked for half the year, you were laid off, and let's say you didn't receive severance, and you're going to take 6 months off to get recharged, rejuvenated, your working spouse can continue to cover the basic needs and some with their income, and maybe we have enough of an emergency fund, or we're leveraging an SLOC, whatever it might be. Well, I now have some wiggle room because I've only earned 50% of my normal income, so my tax situation is going to be a lot lower than what it would be otherwise. So what that means is if I want to keep everything status quo, I can start to convert pre-tax dollars into post-tax dollars so that all the growth moving forward is 100% tax exempt in the future, which is when I'm going to need those dollars for the rest of my life when I exit the workforce. So that, in my mind, is an opportunity to say, hey, let's take advantage of a lower tax bracket. Let's shift some dollars around. Let's move them from pre-tax buckets to post-tax or tax-exempt buckets. And like you said, let's make lemonade out of lemons. The other opportunity is that there could be refund opportunities from a tax filing perspective because income is less. Maybe you paid more into taxes, especially if you had a large bonus that paid out at the beginning of the year. So working closely with your CPA or tax filing professional. If you have the means to do so, maybe making a deductible pre-tax IRA contribution to help reduce your tax liability even further if that's a necessity. Or if you're transitioning, let's just say that you were the one that had all of the family on the health plan and your employer didn't offer a health savings account and the pricing with the high deductible health plan and the low deductible PPO plan just wasn't attractive. Switching over to your working spouse's plan, they may have a high deductible health plan with a health savings account. So now we can make a contribution to a health savings account there, which is another triple tax advantaged account. So there are things that can be done to find the silver lining in the situation from a financial planning standpoint.
I think one of the other call outs there too is oftentimes practice does make perfect, right? In some instances is going through a transition and really testing the fortitude that your financial plan has is good practice for a potential future or more devastating type of emergency or event. It's good to say, hey, the cash flow plan that we've built, understanding discretionary, non-discretionary, it holds up under a little bit of stress. The emergency fund that we have, maybe it was the perfect amount. Maybe next time around when we get back into the workforce, we need to build up some more. And then from an overall planning perspective, hey, we have some actions at hand that we need to consider before jumping right to a decision. And there may be some things that we can take advantage of for better, even in times of uncertainty. So I think it's a good thought or at least exercise to go through, especially if it's a shorter transition, to say, hey, did the validity of the financial plan that we've built and the preparedness that we've taken action on actually hold up? And if not, that needs to be a conversation with your financial professional to say, hey, we were under some real pressure or stress here, and how do we fix this moving forward?
Yeah. And again, hopefully the financial professional that you're working with is stress testing this along the way when making recommendations to say, hey, I am recommending 6 months worth of living expenses set aside because if this happens, we want to make sure that there's no significant change in your month to month, day to day while you try to find your next job, right? Because we don't want clients to feel unnecessary pressure. We want to take that pressure off of their shoulders for them. And one way we can do that is by putting strong, prudent recommendations in front of them to choose from, right? Now, the other thing is that we talked about the financial planning silver linings of the situation. Some of the more personal silver linings might be, okay, well, let's just say that it was a dual income household, young children, and one of the working spouses has always had this internal sensation of wanting to potentially be a homemaker. Well, this could be a forced opportunity for you to test run that. If the math works, if the maths, well, now you know in practice, hey, this is doable. Or maybe you weren't 100% satisfied with your previous job, but it was safe. It was stable. You felt comfortable with it. It was consistent. Well, now you're being pushed into, deeper waters where you have to get comfortable being uncomfortable. And there's an opportunity for growth and for you to maybe pivot into something different. Maybe it's a career change. Maybe it's a better paying job opportunity. Maybe it's a better job opportunity with stronger culture that more aligns with what's important to you values-wise. Maybe it's a position that doesn't require you to come into the office every single day and now you can work remotely, or maybe it's a hybrid. So there is usually going to be a positive silver lining in most situations. It's just a matter of, can we still our minds and our hearts to actually find them and see them and then appreciate them?
So, Michael, I'm curious, and this is just more of a personal question rather than a podcast question here, but have you ever gone through a job transition and were able to find a personal silver lining in any capacity? Or have you seen perhaps a client or friend go through it where coming out of the other side after some stress and some pressure, it really did work out for the better?
Yeah, so personally, I haven't, but my wife, yes. And I don't think she would have any issue with me sharing this, although I don't think she listens to every single episode anyways. But when we were at a point in our career where, or I guess our family, where we were trying to discern, does it make sense for one of us to, take on more of that breadwinner role? She had become dissatisfied with her part-time position, and the culture and the management that she was working with and working for just wasn't great. It was toxic. So it got to the point to where it was like, okay, I'm either going to be let go or I'm going to put in my 2 weeks. And this was around the time where it's like, okay, well, I think we're already at a breaking point where just based on where our family was at, and this was 1 or 2 years post 2020, so coming out of the pandemic. And it was like, okay, well, let's just test run this. Let's really see if we've built our foundation in a manner that will allow us to support this. And so she put her 2 weeks in, and we made that transition. And it was honestly probably one of the best decisions we've ever made. It was somewhat forced in the sense that we had been discerning it, discussing it, and researching whether or not that was right for us as a household, because at that point we had just had our third child. And being a business owner, self-employed, there's risks that come along with that. So her income was nice because it was recurring, it was stable, it was dependable. And so it was almost like we had been praying for that opportunity. And when that opportunity came up, it was like, okay, well, now that the opportunity's here, we can't shy away from it because we've been asking for this opportunity.
Yep.
So now we can either graciously accept it and trust the process and trust that we've made the prudent decisions to be able to weather this, or we can continue to ignore it and continue down this path of being unsatisfied.
Yes, and you learn from your decision regardless of what choice that you make, right, in that instance. So
yeah, and again, we talked about it early on from a cash flow perspective. You really start to identify what's a necessity and what's a want and what can stick around and what needs to be let go. And there's more comforts in our lifestyle budgets than we would like to acknowledge. So it's always nice to be put in a situation where you really have to pick and choose what's a necessity. Because again, coming out of that, a couple things are going to happen. One, you might find more cash flow that you can redeploy towards other meaningful goals and aspirations versus it just being mindlessly spent for the sake of passiveness.
Michael, from what I'm gathering, or at least from what we've talked about, losing a job can oftentimes feel like a failure in the moment, but it's really the spark that forces growth. And the key is to slow down, to get organized, to make intentional financial decisions while emotions are high.
Exactly. Remember, this isn't about just surviving unemployment. It's about positioning yourself for what comes next, making sure you have that survival kit ready and accessible. When you know how to protect your cash flow, your benefits, and your peace of mind, you're already one step ahead.
If this episode resonated with you or someone you know is going through a job transition, share it with them. You never know how much a resource like this can help someone regain financial footing.
And if you'd like us to answer your financial questions on a future episode, head over to www.genesiswealthplanning.com/AMA. Don't forget to subscribe, leave a review, and stay connected. We love hearing how these conversations are helping you build confidence and clarity.
And until next time, plan boldly, live intentionally, and as always,
stay financially fortified.
Thank you for joining us this week on the Financial Fortitude Podcast. We hope you enjoyed the show and learned something along the way.
If you're looking for financial guidance that is personalized to your specific needs, we're here to help. Visit us at www.genesiswealthplanning.com to book a complimentary consultation.
That's it for today. Make sure you subscribe so you don't miss out on future episodes. And as always, please share with others you feel could benefit from the show. See you next time.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific investment advice. Michael Acosta and Brady are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities, products, and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hemmerly's California Insurance License Number 4353077.
7237198.24, expiration 1127.